Tesla made me a lot of money, but it is also this company that led me to realize that I am making a very big mistake in my investment portfolio. And the mistake is I allow this company to be 100% of my portfolio at one point in time. And then the thing is, when Tesla moves, and it can be a very volatile company, the investment portfolio can move by 5 to 6 figures. And this actually cost me my sleep. So in this video, I'm going to share with you this lesson so that fellow investors will not make the same mistake as me. So to share what happened, it happened around in 2020 during the COVID period, and that was the period of time when I have very high conviction in Tesla stocks. That was the point in time when Tesla actually scaled up their Model 3 and Model Y. And you also see a lot of government pushing initiatives to go towards electric vehicles. And after understanding the engineering of electric vehicle, I think that electric vehicle is really the future compared to petroleum cars. So after researching about this and looking at the total addressable market, I decided to all in into Tesla. It made me a lot of money, but it is also a very big mistake because the whole idea of investing is to allow your money to grow. But at the same time, if you are investing in only just one company, what happened is that you allow that company to control your financial future. And during that period of time, I was like reading up about news on Tesla every single day. And sometimes it can get crazy. I can be like reading about 4 to 6 hours just on the company itself. But the thing is, if today, even if you spend so many hours reading up about the companies, there are still things that you cannot control. So, example, even if you know that this company is doing well, operating margins are good, revenues are good, are you able to predict what the CEO will say or do in public? Especially somebody who has influential as Elon Musk. There's no way that you can predict what he is going to say or what he is going to do. And there are many variables that we can't guess. And always remember this, you can be wrong, even though you have invested hours into researching this company. So taking a look at what happened in 2020 for Tesla and comparing the companies right now. So previously, operating margin is one of their strong points for Tesla. But right now, look at what happened. Operating margins are dropping and China electric vehicles are dominating the market. I'm not saying that Tesla is a bad company. Right now, I'm actually analyzing this as an investor point of view on how to manage your own investment portfolio and sharing the lesson what I did. So the turning point for me is that I noticed conviction is good because it allows you to have the courage to take action to invest in any companies that you have researched on. But conviction and concentration is a totally different ballgame. Conviction means you believe in the investment. Concentration means that you are allowing one company to have too much control on your future. And when Tesla moves and the portfolio moves by 6 figures, it is at that moment I realized that this cannot continue. I'm allowing too much control from this single company. And that was the time that I decided that instead of maximizing return, I want to improve survivability and to survive uncertainty. So my approach right now is not thinking about how can I find stocks that give me the highest return, but more on how can I design a portfolio that can ride through uncertainty. So what I did subsequently itself is that I tapered down my holdings in Tesla. Rather than allowing my financial future to be controlled by a single company, I decided to diversify into multiple companies. So I'm still a big believer in technology, and I believe that technology is the sector that will improve productivity along the years. So the valuable companies are definitely in this segment. Hence, my portfolio is still heavily invested in tech. So I diversified across the tech companies with free cash flow, strong revenue, strong profit, strong operating margins, such as like Amazon, Google, Microsoft, Meta, Nvidia, so that I don't have all my eggs into one basket. And on top of that, rather than just relying on the US market, I also invested into the local banks, which are more defensive, giving a good yield of 4 to 5%, which is something that is totally unrelated to my US tech sectors. So I think the strategy worked well. As you can see, the recent years, when tech suffer, the local banks itself, they are still performing. And on top of that, I also added on like broad-based indexes such as the VWRA into the portfolio to create more stability in the investment portfolio. So this allowed me to have more exposure to different sectors, different companies, different countries, and also less impact even if a single company tanks. So diversification allowed me to still continue to be ambitious and also give me a higher chance of surviving through uncertainty. So right now, the portfolio, it does not rise as much compared to, let's say, if a single stock jumps by 15 or 20%. But now, one company does not control everything. The portfolio is more durable, and I'm not so sensitive towards single company movement. And the most important part, I can sleep better at night. So the main lessons here is I understand that concentration can build wealth quickly, but you have to understand it is a double-edged sword. It can also destroy wealth quickly. And even though I'm trying to diversify, I totally understand that diversification does not eliminate risk, but it does protect me from things that I cannot predict. And we know that the important part about investing is compounding. And if let's say your portfolio is designed in such a way that a 20% drawdown will make you panic, there's a high chance of you not allowing your capital to compound, because when the portfolio dropped 20%, all conviction is out of the window. And remaining invested is actually the best way to do it. And how do you remain invested? To ensure that your portfolio can survive through uncertainty. And hence, diversification works in this favor. So I think especially right now in times like this, people are going crazy into the artificial intelligence space. You want to all in Micron, you want to all in the semicons. And I think the recent drawdown actually gave us a good lesson also. If your portfolio moved more than what you would want to during this pullback recently, and I would say that this pullback isn't one of the scariest I have seen. And if as of now you're not comfortable with the current pullback, and by any chance if you chance upon this video, I hope that this video allows you to have another perspective of designing your investment portfolio. Is it a time to actually trim down the exposure to single companies to control your position sizing and allocation? So all in all, I still believe in technology sectors, the Tesla mission, but I no longer want my financial future to be depending on one single company. And the best portfolio is not the one that is positioned for the best return. I think the best portfolio is the one that allows you to hold through all uncertainty without losing sleep. So one closing question for you. How much in terms of percentage are you willing to allocate to a single company in your investment portfolio? I'm curious to find out. Share with me in the comment below and we can have a good discussion. So if you like videos like this, do hit on the like and subscribe button so that more videos like this will be recommended to you. I'll see you in the next video soon.